going on? It is Tuesday, the 12th of March, and well, CPI came out today. That is the big news that that hit the market this morning, and it's hotter than expected, which is what we all figured would be. What's interesting is I'm not looking at any revisions here. I don't know why it's not showing me the revisions. There would have been some revisions in here, but there's not. But don't understand that one. It's not showing me the stuff. But ultimately, we do have CPI showing that inflation's continued to build, right? As much as they keep claiming, hey, we got inflation under control, we're going to start lowering rates. Good chance that they may not lower rates in the second quarter, guys. If inflation's going up and they've held it and they were planning on dropping it when they show inflation getting better, the CPI and the PCE getting better, and they're not. All these mortgage guys are saying, oh, they're going to lower rates in 2024 and they're going to do it 4 times or 5 times, wherever their speculation was to say we're going to get better rates. We're not seeing it. So this is first quarter, right? Got the readings coming out. We're gonna have another reading next month for what's happening this month. And if it doesn't get any better, which they haven't moved the rates up, they haven't moved the rates down, they're holding them still, and it continues to get a little bit higher. Also, the jobs report that came out last week was complete crap. I'm going to hold off on talking about that till Friday. I'm going to get Patrick on here. That son of a bitch is ready to go off about the jobs report and the jerk-off information we got there. So let's take a look at how the market reacted to CPI, which is actually not as bad as I thought it would be. I thought it would be pretty heavy duty, but it didn't. And there's a reason why. So what we have here, and I'm going to zoom in on this a little bit better for you so you can see it. So what we have here is this level that we've drawn from way back, as one is kind of a one of those spots where there's going to be orders placed by traders. It came off of that level, and then of course off of that level we had yesterday kind of trading there in preparation for what CPI is going to do today. But look at negative movement all the way down to this particular that looks like the 200-day moving. No, sorry, that is not the 200-day. That there is your looks like 50-day moving average. Hit that, came back off of it, touched in here, but is negative because of CPI. That is showing the economy is getting more expensive. When things get more expensive, then bonds, which is a long-term instrument that people are going to hold for a long time, they're going to get less and less money. That's what I talk about with your 30-year fixed. You're actually paying less the longer you take to pay. Well, if you're the person holding the note, you're making less the longer you hold that note in an inflationary environment. So that's why inflation is important for you, the real estate investor, to understand that it actually benefits you for an inflation environment, especially when we lock the 30-year fixed. If you're expecting rates to go down, because your guy's telling you, oh, hold on, we're going to see what happens. I've got key levels here that I keep watching, and we're not getting to a point where there's enough information to make it get past that. We also have that really strong level up above where that price point set back in 2008. I don't know that we're ever going to see us get better than that without quantitative easing, and that quantitative easing has got to be huge. So let's take a look at bankrate.com, see what's going on in the world of mortgages for your average individual. This is going to be the place I go when people say, hey, what's the interest rate today for owner occupied? Look here. This is going to be pretty close. So bank rate, scroll down to where you see the little girl on the yellow slide. Better rate is waiting. Click on mortgage. Look at this. 7.18% for your 30-year fixed home buyer. They're going to live in it. This is their primary residence. But this is actually delayed. It's going to come off of this. This is from the 8th. So we're going to see it go back up. It's going to be about 7.2 to 7.3 with this news that we've got. Interesting. Look at banking. CD rates, flat as hell. Mortgage rates all over the damn place. You can't tie these all together the way people try to. So that's where we're sitting right now. If you didn't lock, I'd encourage you to lock. Stay ahead of it. We don't know where this direction's going. The big worry I have, if everybody's wanting to wait and see what the Fed does, the Fed doesn't lower rates because of what's happening with CPI and inflation, then rates will probably go up, because everything's baked into the market for the Fed to lower the rates 3 times this year. If the CPI is not going down, if the inflation readings are not going down, they're not going to lower it, guys. They just can't. And if that ends up being the case, what's going to happen to rates if it's already baked in? So do some thought on that. Call me if you have questions about it. aaron.chapman.com, and wait till we get Patrick on. He's going to blow up over some of this stuff. It's basically fraudulent numbers that we're getting. We're being fed this crap. So we'll talk to you on Friday.